Defined risk option strategies on a risk graph. We previously introduced the basic components of a risk graph, including the profit and loss axis, the underlying price axis, the zero break-even line, the profit and loss zones. We also visualized both long and short stock positions. Now, in this lesson, we will introduce basic defined risk option strategies such as buying a call or buying a put. To do so, let me introduce the expiration line. The expiration line on a risk graph is a visual representation indicating the potential profit or loss of an options position at the option's expiration date. This line reflects the value of the option based on various prices of the underlying asset at expiration. It's the green line there. So a long call position, strike price. A long stock is purchased at the stock's current market value, while a long call can be purchased at the investor's chosen strike price. You can see that there in the strike price. And then the break even, which is the strike price plus the premium paid. So it's here, the break even. And then you have the defined risk or the limited risk. It's the maximum risk in a long call position. It's limited to the premium paid for the option, regardless of how much the stock price falls. Here. Now, long stock, unlimited profit potential with linear profit growth as the stock price rises from the purchase price. The risk or loss potential with the long stock, you have higher risk with the potential for the entire investment to be lost if the stock price falls to zero. Comparing it to the long call, you have the profit potential, which is unlimited profit potential as the stock price rises beyond the break-even point, increasing as it goes beyond the strike price plus what you paid for the premium. And the risk of the loss, the potential loss, is limited loss, with the maximum loss being the premium paid if the option expires worthless. Next, I'll get into a live long call example. Okay, here's a risk graph. This is an example of a long call. This one's about 30 days out. It's going to expire in about 30 days, just buying one long call on SPY and what it looks like on a risk graph. You can see here the expiration line, right? And buying a call, you can see if the price goes up, you're going to be in this quadrant up here where you're making money. And if the price goes down, you're going to be down here losing money, but you're capped is how much you can lose. You see how you just never can really lose more than, if I'm looking over here to the right, about whatever you paid for it, about $946. You're not going to lose more than that. But if the stock goes up, say it goes to 560, right now it's currently at 496. If it goes to 560, you might make, like I'm looking over here, close to $6,000, $5,700. So you have a lot of upside potential with a long call and hardly any downside potential with a long call. Let me come into this a little closer here, but you can see here that for this call to make money at expiration, this is the expiration line. So in 30 days from now, it has to go to at least 503.37. So your probabilities are a little bit lower, right? Because you've got to get over that hump of going over, $504 just to start making money. So your statistical odds, are that you're probably, you may or may not go over that, but there's good odds that you might go down too, and you'll take this full loss. But your downside is limited to around $950 with the long call, but your probabilities, you don't have, the chances are now you have to break 504 at expiration to make money. So your probabilities go down a little bit, but that's what a long call looks like on a risk graph. So a long put involves buying a put option. The objective is to profit from a decline in the asset's price, and the market outlook is bearish. And you can see the maximum profit zone here, where below the strike price at expiration with potential substantial profit if the asset price drops. So if the price goes to the left, drops, you can see the unlimited potential. Next, I'll get into a live long put example. Here's a risk graph with a long put example. This particular put expires in about 30 days, 31 days. You can see here the price of the underlying is right here, 497. This is SPY. And with the put, when you buy a long put, you are short, right? You want the stock to go down. So you can see, let's say, for example, if it goes to 475 at expiration, I'm looking at these numbers over here on the side where it kind of coincides. So 475, where it hits that expiration line. So you'd make about $1,200 over here. If it went down, now if it goes up, you are going to lose money, but not like you're long, or not like you're short stock or anything, because you have a limited downside risk. How much you paid for the option, around 560 bucks, it looks like. So that's your risk, right? $560. It doesn't go any more beyond that. That's the most you can lose. Or why not always buy a put, right? If you're short. Well, the thing is at expiration, the put price has to go below about $487 just before you start breaking even. So if it doesn't move all this way, you are going to lose money by expiration. So it has to go here and then beyond that for you to make money. So it has a lower probability that you're going to make money. But of course, your downside to you're capped on your risk. So that's a good thing that your risk is capped. But the bad thing is the probability that it has to move all the way over here below 488 to make money. So you can see how that expiration line happens. And these lines are just the lines in between expiration of what happens in those days in between where you'll be. But again, in short, being long a put is like being short a stock, but you limit your risk, but you also lower your probability of making money. And you can see here how much money you would make when it goes down and how much you would lose. If it doesn't move at all, you're going to lose all your money. And as it moves higher, the stock moves higher, you're going to lose the $570 you invested. Now, buying a put, going long a put, or buying a call are both examples of a defined risk strategy. Defined risk. The maximum possible loss is known and limited right from the start of the investment. That's what defined risk is. And this makes the risk predictable and capped, unlike owning the stock outright, where the risk includes the entire value of the stock. We'll see you in the next lesson. My new book, it's out, called All Market Trading Profits. And for those who don't know me, my name is Carl Dahm, and I'm also known as the Transparent Trader. My marketing guy, he convinced me to write a book that shares my secret trade details with you. It's the same trade I used to make $597,210 in third-party verified profits from 2019 to 2023. I'm not sure how long I'll keep these secrets in my book, so you might want to grab a copy before I change my mind. Don't miss out. In my book, I reveal the unique trade structure I developed, something you won't find anywhere else. The book isn't AI-generated content. It's real organic material. If you're interested in learning the trade that drives over 70% of my net worth, click the link in the description to get the book and see how I achieve my results. The book is $30 on Amazon right now, and I'm offering a downloadable version for only $5. See that link in the description.